Fantastic. Time will start on my next word. POIs in chat preferably. Thank you. Start at the top with some characterization. Couple of things to note here. First, who is going to provide this political risk insurance? There are already companies that do this in the status quo. We believe they'll just take the job of it, except now it's mandatory for everyone. By mandatory, we mean every single company or entity that wants to do foreign direct investment within a developing country, which is we're considering the developing world, is going to need to buy some sort of insurance. And in addition, what is this insurance company covering? Basically everything that's mentioned in the info slide, in addition to corruption and other such occurrences. So let's do some characterization. What does the developing world look like, and why is it so dangerous to invest there in the status quo? Two key pieces. The first one is that the developing world is incredibly volatile due to either one, constantly shifting governments, or two, rather strict and, well, not strict, rather they're corrupt legal authorities and a lack of transparency and accountability in enforcing these rules. The second one is a large amount of corruption and a lack of transparency, which makes it difficult for you to ascertain whether or not your investment is actually being done or made use of in a timely manner, which leads us into our main argument on why we're bettering investment by forcing everyone to use a political risk insurance company. First, thing to know, political risk insurance companies are not as powerful as opposition would like to make it sound like in the status quo. Couple key and are unable to provide a lot of incentives or benefits in the status quo. Two key reasons. The first one is that there are a lot of companies that are simply unable to afford this political risk insurance in the status quo. And two, the companies that can afford this political risk insurance, major corporations, have no need of it because they're already large enough to support or take any losses on their own. Thus, political risk insurance companies are not able to, they don't have the resources in order to cover everyone right now. That's why it's so important to make it mandatory so that everyone is forced to partake in this system. The first burden, which we've already proven, is that investing in a developing world for the vast majority of companies is incredibly dangerous. One, due to the volatile and shifting governments. Second, you have a lack of transparency. And three, there's a lack of accountability and oversight in that country. So you just don't know what's going on with your money. Why is investment in political insurance going to cover all of this? There's four key mechanisms we can give you. The first is that there's just going to be more investment if you have a bunch of people investing, having a mandatory political insurance, because the confidence goes up. You know that if your investment falls through, if it gets corrupted away or some sort, or it gets lost or damaged in some form, that you're going to get reimbursed for this corporation. The second thing is that you get more companies under these political insurance companies. This is where the crux of our case comes in. By making it mandatory, you're forcing everyone to use this political insurance company. When this happens, the political insurance companies get massive increases in revenue and streams. Most of this revenue is going to come from large investment corporations at first that can afford to pay for it. Once this happens and the political insurance companies has enough revenue to expand their operations, then they can afford to cover smaller companies at lower prices, and they have an incentive to do this because in the status quo, these companies can't afford it right now. Now, the second thing is that there's likely going to be standards for how these companies are going to set their price to avoid saying things like some companies simply can't afford it. If it's made mandatory, then these companies must, in some form, lower their prices to be affordable, and they are able to do that in our world because of the increased amount of revenue they have received from larger corporations. The second thing to note is that we're going to have better standards for safer investments. Remember, these insurance companies, they don't want to lose money on terrible investments that are going to be corrupted away. Therefore, with a large amount of people focused around these public insurance companies, they're going to have standards on what investments that are going to be considered safe and approved in order to actually get this insurance. This is important because it results in overall safer and better investments, because these investments are, one, going to be more transparent, and two, because you're carefully monitoring each you're going to have additional incentive from these private political insurance companies to ensure that these investments are actually worth it. The third reason is just you're going to get a lot more investment, since companies that did not have the incentive to invest in the developing world due to potentially losing their money due to corruption now have, one, safer standards in order to invest in, and two, they have a safety net to catch them in case the investments fall through. Before I continue, I'll take a POI now.
I think the problem with safer investment is that after time, that is after I've already invested and bought insurance, my incentives are misaligned. And now if I'm an investor, I want to cause political instability so I can collect on the insurance payment.
The problem here is that if a political insurance company tries to cause political instability, they're going to lose money. And also, there's going to be safety standards. There's already standards in the status quo from stuff like the IMF and World Bank. It's very absurd to think a couple companies are going to come in and cause major disruptions because that makes them enemies of everyone, which makes them liable to getting charged. Remember, if you cause instability, you're also making enemies of yourself from major world powers like China and the United States. It sounds really dumb for a company to attempt this. Third burden, which we've already semi-proved, why is making it mandatory crucial? Right now, public insurance companies, in order for them to cover everyone, you need to give them the resources to do so. By making it so that everyone must buy this, you're expanding the coverage and making it able for them to cover it. It also makes a better incentive and standards if everyone is using it. Why is it so incredibly? So what are the impacts of this? One, we're just giving better infrastructure, and this is beneficial for a couple key reasons. Right now, in the status quo, when investments go into a country, there's no expectation or there's no guarantee that you're going to get any actual infrastructure. Think of China investing $100 billion into Nigeria and then coming out with a faulty rail system. The main reason for this is because a lack of transparency and corruption. A lot of that money just ends up going to nowhere, which makes it incredibly risky for companies to invest. If company, like we mentioned earlier, this standard of investment increases because now these insurance companies have an incentive to ensure that this money is used. So there's more accountability, there's more forced transparency, and you're just going to monitor your money more closely because now you have a major other incentives to actually monitor this. So this results in actual infrastructure. One, the investment money is put to better use because one, there's more of it, and two, it's guaranteed to go to a better place than it is in the status quo. This results in one infrastructure actually being constructed, which results in the country. A couple of types of infrastructure. The main one is rail and transportation, which results in the country being more connected. It results in goods being transported better, more consumption, higher quality of life. Two, quality of life infrastructure, such as better water supply and new apartments. This would increase the standard of living per family by ensuring access to clean water and also safe shelter. For these reasons, strong go.
Thank the PM. Call on the.
I'd like to take my PIs verbally, please. Two very simple cases coming out of O today. First, on why FDI is likely to decrease on their side of the house, and secondly, on how it decreases the amount of pressure that MNCs and foreign governments place onto the governments of developing countries and why that's bad. First, on why FDI is likely to decrease on their side of the house then. First, I want to note why this insurance is likely to be very expensive, even if it is the case that it varies by country based on like how risky they are politically. Say if there's a communist government who comes in and like seizes all the assets, then the insurance company is going to have to put up hundreds of millions of dollars in order to cover all of these losses, right? Even if opening government is right that more people end up participating within this like insurance system, this just increases the potentiality of risk because there are many, many more actors investing in many more like risky developing countries, right? Secondly, so it's very likely to be expensive for that first reason. But secondly, we think that not many actors are currently offering political risk insurance and are very unlikely to offer political risk insurance, right? So there's probably an oligopoly or like a monopolistic situation in this case. First is because it requires a lot of political expertise or a lot of economic expertise in order to, say, assess the political risk of a specific country and know how to price your insurance such that like people are willing to buy into it. Meaning the barrier of entry is quite high, but also there's probably an element of like what people are willing to, like what corporations that are offering this insurance that people are willing to buy into. And there's probably a sort of like bias in that regard. So we think that this insurance is quite likely to be very expensive. Second, why do we think that this means that FDI en masse is going to end up decreasing? So we think that this probably means that foreign investments in general just become much less appealing because they become much, much more expensive, right? So perhaps it is the case that now a lot of investors are now turning to like developed countries or simply divert their investments to domestic markets where they can reap the full benefits of their economic investment and their return on investment, right? So it's probably the case that many of these corporations are quite large because those are the ones that have the capacity to do things like invest in foreign economies. We think that it's like perfectly all right for them and probably like very attractive to them to be able to reap the full benefits of their investments, even if it is the case that it's like a smaller percentage of profits rather than perhaps invest in foreign economies and not gain all of that money back. what do we think the counterfactual on our side looks like then? We think that on our side, the counterfactual is simply that investors strategically choose when they're doing things like getting political risk insurance, right? First, I'd like to note that the entities currently doing FDI are usually large companies because those are the ones that have the capacity to say like hire lots of fancy consultants, but also do things like invest significant amount of money into foreign economies. So they also probably have the capacity to do things like hire lots of consultants, use AI models, or have many skilled workers that are doing things like analyzing what types of economies that they should invest in, and also when it is probably necessary for them to purchase this type of political risk insurance. This probably also means that it's not necessarily a problem, like it's not really within the realm of this debate whether or not they can afford the political risk insurance, because we think that, you know, they are quite large and they are quite wealthy. So if there is a stable developing country, I think it's quite like silly for you to require them to get political risk insurance, especially if it is the case that this means that they're going to perhaps decrease the amount of money that they're investing into these types of countries. And secondly, we think that it just means that these companies are likely to get political risk insurance in ways that most maximize their profits. So if it is necessary for them in a specific instance, they'll get it. Otherwise, they're not going to get it. And I think that's quite reasonable to ask of them. So why is it important then for these investors to do profitable things? And secondly, on why FDI in general is important. So first, we think it's very important for the investors to do profitable things for themselves for three reasons. First is that when they get money back, they can reinvest within that developing economy, having a multiplier effect on, like, say, the local economy and the ways that those corporations are likely to be able to develop economically, and to create trade with other businesses or with other consumers. But secondly, we think it increases the flow of money into the country when other investors are also able to see that this specific corporation is getting a high return on investment on their types of investments. So you just increase the net amount of investment that is flowing into these countries. But thirdly, we think it is the case that just these companies are quite large and they hire lots and lots and lots of people, and it's probably good that they gain more profits so that they can hire more people. At the very least, we create more employment. Finally, then, why do we think that FDI in general is very important? We think that FDI is good because it creates jobs. It does things like spur innovation within the domestic sector by creating new commercial market pressures. It boosts the export sectors of developing countries and allows the transfer of technology into poor nations and develops human capital when foreign companies do things like train workers or provide them with education. If you make FDI much more expensive by forcing all corporations to opt into political risk insurance, even if it is not necessarily profitable, we think you greatly decrease the amount of FDI that you get, and critically, you decrease it when it is probably the most necessary. Before I move on to my second point, CG? Okay, secondly, on how it decreases the pressures of MNCs and foreign governments onto the governments of developing countries then. We think that in the status quo, there's a high pressure to have a very stable, consistent legal environment for the buying and selling of goods and services from both MNCs and foreign governments. So this looks like pressures not to socialize or pressures not to nationalize, or all of the things that make it unappealing for these countries to gain FDI from other actors. Why do we think the incentives change on the other side of the house then? Recognize that the only reason governments currently engage in these actions is that the potential loss in assets through expropriation is much larger than the cost of putting pressure on these governments. So when these losses no longer accrue, or when these losses are now covered by insurance, there's little to no incentive for governments and corporations to do things like place pressures on the governments, to not do things like perhaps have tendencies to expropriate, or there's no more pressure placed on these governments to not do kind of like batshit things, right? What do we think the counterfactual necessarily looks like then? We think that on our side, governments and corporations have very large vested interests in ensuring that they don't lose all of their money in risky investments, and specifically in risky governments. So they already manage the political risk by doing things like investing into the political ecosystem in very smart ways. So perhaps they do things like invest in political parties that support increased economic liberalization, or they do things like they increase the amount of funding that they have, or they're more invested in kind of like the political outcomes within these countries themselves. We think that this is already a way that current companies and governments do things like manage political risk. But secondly, we think that companies are likely to do things like take diplomatic action against perhaps these countries that they find more risky. So perhaps if you are a government and you know that you have this very large corporation that is currently investing like in a different like foreign country, then you now have a vested interest to ensure that that government is acting in ways that are accountable towards this corporation. We think that these are just very good incentives for these governments to have. So for example, if you are the Canadian government and you know your company has extensive political risk insurance, you're less likely to put pressure on, say, like Libya to not expropriate, because now you're no longer afraid of becoming bankrupt, right? So we think that on government side of the house, you have much less pressure, and you are likely to have much worse political outcomes within these developing countries, which then leads to them becoming like less attractive for FDI. It also leads to just massive losses incurred for both the corporations performing that FDI as well as other investors. Okay, so on both the basis that that government is likely to decrease FDI, as well as the fact that we think it's good that MNCs and foreign governments have vested interest within like foreign governments in the status quo. Incredibly proud to.
Take yellow, call DP.
Hi, am I audible?
Yeah.
All right. Time will start on my next word. POIs in the chat, please. Thank you. So the leader of opposition comes up here today and gives you two main arguments. They tell you that foreign direct investment is going to decrease, and they tell you that there's going to be decreased pressures on the government to do right things. We're going to go point by point, and over the course of the 7 minutes, I'm going to take their entire case down. So number one, on what they say about insurance, number one is going to be expensive, right? They're going to tell you that insurance is going to make like multinational corporations pay millions of dollars, and it's going to make it expensive, right? As opening opposition themselves has said, the debate is not about whether these companies can afford this risk insurance, because they can. So the debate is about whether they will choose to do so. All right. And I'm going to rebut this by stating that insurance companies themselves are going to be smart about this. So yes, even if they may charge something expensive, they're not going to charge something out of proportion that prevents an MNC from choosing to literally invest in a country, right? Because if they do so, that basically means they're not getting any investment, they're not able to bolster their company, and essentially there's just no FDI in general. So insurance companies have an incentive to make sure that prices are somewhat lower in order for existing companies that are currently doing FDI to continue to invest in this country and pay risk insurance, right? But they tell you that that's going to most likely take the form of like an oligopoly or like a monopoly, right? So let's consider that it does take the fact of an oligopoly or a monopoly, right? In the worst case scenario, nothing changes in a sense. FDI still comes in because multinational corporations are still going to be coming in, because even if they're an oligopoly or monopoly, they're still going to have an incentive to maintain costs that allow MNCs to come in. But what does this mean is that if this is likely to happen, that means that these risk insurance companies are now getting extra money from MNCs, which they are now able to use to hire more people, expand their operations, and potentially reduce costs in the future. So in the worst case scenario, we still have a benefit on our side of the house because we're propping up an entirely new industry, right? But we're going to tell you that it's most likely not going to be the case that it's going to be an oligopoly or monopoly. We're going to tell you that it's going to be free market, right? Because the antitrust system still exists in a lot of countries. MNCs still have sway. They could tell governments, hey, this is exorbitant. We're not going to invest if something like this happens, right? So the free market still exists, right? So now they also tell you that the counterfactual is likely to be, that they're going to do it in developed countries. They're going to take their FDI out of developing countries and do it. And I'm going to tell you that's not the case. Why do people do FDI in the first place? People do FDI because one, there's cheap labor, and two, there's just generally more opportunities for infrastructure that you don't have in developed countries, which means that their entire counterfactual is probably unlikely to happen, because even if you have risk insurance and you're paying risk insurance, you're still likely to have greater profit in a developing country than you are in a developed country, simply because of the fact that the labor is cheaper and there are numerous other opportunities. Now, opening opposition also comes up here today and talks to you about why FDI is important. And that is something both sides of the house can agree on. FDI is extremely important, and it's about which side of the house brings better FDI, right? They tell you, number one, that they're going to reinvest money. If you do FDI, if you're free to do FDI, you're going to get profit that you can reinvest. And we completely agree with that. And that is why our side of the house wants to make it mandatory for you to invest with risk insurance companies, because that means you're going to have a continued incentive to continue investing in this country, right? And what opening opposition fails to miss is Will's mechanization as to why developing countries are heavily volatile, which means that if you're a company and if something happens to your investment, you are less likely to reinvest in that particular country for a long period of time until the government changes, until legislation changes, which is probably not going to happen in a very long time, right? So if that happens, that basically means you're not going to be reinvesting the money that opening opposition is telling you about, panel. However, if you invest in risk insurance, if you are guaranteed that you're going to get your money back, that essentially means that you will still reinvest even if something bad happens to your investment, and you're not going to blacklist a government for doing so. Right now, what happens is if something happens, companies are turned away away, they blacklist governments, and that country starts to get lesser and lesser investment, which is overall net worse for the entire industry as a whole, right? They also tell you that they're going to hire more people. And this impact is based upon the first. If we give you mandatory risk insurance, you're probably going to reinvest your money, which means you're going to hire more people. So in order for opening opposition to actually achieve the impacts that they're talking about, they need to go through our side of the house's impacts first. But number two, they tell you that there's going to decrease pressure from the MNC to the government. Okay, and we're going to probably we will accept the trade-off that yes, there might be some decreased pressure from the MNC to the government. But it's important to note that now we have another player in this industry, which is risk insurance. But before that, POI.
Your argument that there is no backlash against nationalization is terrible because it means that leaders in developing countries can do things like nationalize Petrobras without fear of retribution and cause broader downturns in investment in the long term.
Okay, so thank you for that. So like I was going to say, their second point is about decreasing pressure from the MNCs to government. And I'm going to answer this POI through my rebuttal of that argument, right? They tell you that MNCs are not going to put pressure on the government, and we're willing to accept some sort of trade-off that may happen. However, there's a new industry, which is risk insurance. And risk insurance, most of them are probably going to be domestic, which means they're going to also be able to put pressure on the government and file local lawsuits if they have any sort of issues with how the government is doing things, right? So even if MNCs don't put the same amount of pressure that they're putting right now, we're still going to have risk insurance companies who don't want to lose their money, who don't want to lose their investment. They're going to probably also be pressuring the government. But it's not that MNCs are just not going to pressure the government. I find that entire take highly absurd. MNCs are multi-million-dollar companies, multi-billion-dollar companies who have an incentive to get their money back, but also to continue reinvesting. They will still continue to put pressure on these governments, and so will the MNC's government do so as well. So yes, while there might be like a little bit of change in terms of the pressure, it's not really substantial for OO to have any sort of impact whatsoever. So what have we told you today? William came up here and told you that there's going to be increased better and safer investment, right? And why is that the case? Because he told you that now companies are not scared to continue reinvesting because now they know that they're going to be reimbursed on their investments. And what does that exactly mean? It means investor confidence has gone up. There are more companies that are coming in now because they want to invest. There's a brand new industry propped up, which is risk insurance is propped up, which is providing thousands of extra jobs. You're also creating more infrastructure, which means you're allowing families to see each other every single day. You're creating thousands of jobs. You're making better utilities. And all in all, this seems to mean that our side of the house brings you the impact that FDI is supposed to bring, which is more investment and higher standards of living. Opening opposition has to contest with this.
Thank the speaker, Colin.
All right, am I audible? Sorry, did you nod? I couldn't quite see. Okay, great, thank you. Okay. Please don't unmute for POIs, I'll call for one. Three, two, one. I want to begin with some framing. In the status quo, many corporations buy political risk insurance. They do this because there are some cases in which a country is very profitable for maybe oil extraction or whatnot, but also simultaneously politically unstable. And so they really want that oil, but at the same time, they want to ensure that the company doesn't fall apart if things go south. So they buy PRI. For this reason, PRI firms are already actually quite viable in the status quo. And Gov had a burden here, which is to prove why it is that PRI firms need even more money in order to be offering sort of reasonable rates, why it is that they need literally everyone to be in this pool in order for PRI firms to be able to offer the good things that they outlined to you that they offer. Because they failed that burden, I think they've already lost this debate, but regardless, let's go through some line-by-line refutation. The first thing they say is that the developing world is dangerous to invest in. And of course, this is true, but investors know this. And so, as my partner proved, investors buy PRI exactly when it is profitable. They go to their consultants, they go to their AI algorithms, they see, should we buy this? Would it be a good idea? And then they do so. Great. Next, when Gov says that we get more investment and their side, of course, there's less, because insofar as we've proved that our world is one in which FDI investments are fundamentally more profitable, then you get less investments if they are indeed less profitable. Now, where do these investments go? Because we get some pushback here. We explained why in many, many cases, they'll go to non-developing countries, countries where you won't have to pay these extra insurance premiums. Their response to this is quite laughable. It's that developing world investments are always going to be more profitable, so there's no trade-off here. Gut check this. If this were true, why wouldn't literally every dollar of investment money in the world right now be going towards these developing countries? Obviously, we see the amount of FDI into countries ebb and flow in response to how profitable the industries in these countries are, to how many natural resources they have, to the political environment, etc. Clearly, there's a wide range of possible trade-offs in terms of where investments flow. If you make FDI into developing countries less profitable, obviously it is likely to go elsewhere to a significant extent. Great. Let's talk about their only substantive analysis, which is on why it is that we make PRI firms offer cheaper coverage for small corporations. I want to start by flagging one thing, which is that they're missing a super key link. And it's between PRI firms having more money and PRI firms offering cheaper rates. They, of course, prove that if PRI firms have more money, they have the capacity to offer cheaper rates, sure, but they never once proved the incentives for these PRI firms to slash their rates that they're offering to companies at the point at which everyone is buying in. And the response to this is, well, if it's mandatory, you simply have to lower your prices in order to be affordable. But no, the mandatoriness is on the buyer's side, not the seller's side. So the sellers can and will keep their prices high if you buy their characterization that the prices are high in the status quo. But no, we can flip this and explain why actually there's going to be higher prices in Gov's world. I know this sounds ridiculous, but trust me, I'll get there. Please, Max. Come on. Okay. Three main reasons. The first is just one on characterization. There are going to be relatively few PRI firms on both sides. It requires tons and tons of money, and it requires tons and tons of expertise uniquely. Connections all around the world, legal experts, sort of consultants, financial experts, all that jazz. And we explain why there's going to be tons and tons of collusion between these PRI firms in order to avoid a competitive marketplace that might theoretically lower prices. What's the response? The response is, well, anti-monopoly laws exist, ergo they're going to be well enforced. The problem is that these PRI firms are in the vast majority of cases international corporations. They're headquartered in places with maximally lax laws. So they aren't going to be headquartered in the United States, where the laws would in fact ensure maybe that these international corporations are behaving in ways that are cool for consumers. No, they're probably going to be headquartered in the places where it's most strategic for them to be headquartered, namely the places with lax laws. The ultimate endpoint of this is this. In ops world, when you can choose whether or not to buy PRI, you can say fuck off to the PRI firm if it sets its rates too high. By contrast, in Gov's world, you are forced to buy it. So regardless of the rate at which they offer you, you necessarily have to take one of those rates. Clearly, prices are lower on our side. Clearly, then, the FDI is more profitable on our side. Even if you buy at the end of the day that Gov has proven to you that this motion means a cash transfer from big corporations to small corporations, in other words, even if you don't buy any of the rebuttal I've given thus far, this is still a bad thing. Big corporations are the ones that do the most important work in these regions, the sort of infrastructure projects that they talk so much about. We probably want to prioritize big corporations investing because they have the most capacity to hire as many workers as possible. I don't really care about a few tiny corporations maybe getting marginally better access to South Sudan. Great. Let's do some rebuilding, but first to POI. Please.
Yeah, I think the question is, if it's the case that like investors are going to strategically opt into FDI, the problem is only the largest firms on your side are able to do so. At the point at which this makes it much harder for FDI in general to go, I don't know why this FDI goes necessarily to the most important countries.
I've already explained to you why it is that the prices for small firms won't change on either side, and if anything, they're worse on your side. That responds to that POI. Great, rebuilding. So I've already explained why it is that clearly we get less FDI, and Gov has already agreed that's the most important impact in this debate, so that outweighs everyone else in the round if we win on this clash. But let's talk a little bit more about the point on pressure on developing countries and their governments. We explained to you why it is that for both Western governments and Western MNCs, they're going to put way more pressure on governments to be normal, to not nationalize everything, to make sure that the country is stable. They're going to promote political parties that are conducive to these aims, et cetera, et cetera, et cetera. And we're, on our side, they're going to do that way more because, of course, if the country goes to shit, you lose all of your assets, whereas in Gov's world, if the country goes to shit, you just get a payday from the insurance company. What are the responses to this that we got? There's two. One is that on both sides, you're obviously just going to pressure the government to be normal and chill, dude. But obviously, the delta is the amount of pressure. how much time and energy you spend on this. So how much money are you going to spend on lobbying these governments? How much money are you going to spend on propping up pro-business, pro-stability parties in regimes torn by ethnic conflict? The same thing applies for the pressure from Western governments. Obviously, Western governments don't want to piss off their allies or potential allies. Obviously, in the new Cold War between America and China, Canada would rather not piss off Libya, but maybe we will be more likely to piss off Libya a little bit by putting pressure on them to be nice to our companies, to not treat them in ways that are likely to deprive them of their assets, when we know that maybe our domestic country or maybe our company will go bankrupt if Libya does indeed do those things. So clearly there's reasons why governments won't want to put pressure on each other. So there are trade-offs here. Okay, second response from them is, well, we create a new industry, which is the PRI industry, and it's domestic and it puts pressures on these governments to do all the same things that we outlined to you. This is woefully implausible. I'm serious. Imagine a South Sudanese PRI firm. It would obviously lack the capacity to exist in the first place. And also it would just be stupid to put PRI firms in unstable regions, because the whole point of a PRI firm is that it's immune from the appropriations, immune from the political instability that is characteristic of developing countries. So clearly these PRI firms would be put outside of developing countries. The end point of all of this is we get way more pressure on our side on countries to be more economically and politically stable. This is not only inherently good, but also instrumentally good insofar as it increases FDI, because we get more money, more jobs, more food on mouths, whatever. So proud to oppose. Thank you.
I think the DLO call on member. Yeah, you can turn the recording back on.
Okay. I'm going to prove three things in the speech that wins this debate. First, why companies have incentives to invest anyways, even if the costs of insurance are high. Secondly, why corporations on their side are not just going to buy insurance, even when it is rational, even when it is important, and why they're going to be overly risky. Thirdly, I'll talk about the counterfaction and why that's worse. So first, why are companies going to invest anyways, even in the worst case when the costs of insurance are high? And the reason we get out of opening government is just, oh, there's cheap labor. But my question here is that why is cheap labor, more important than, for example, the cost of insurance? And I think the better and stronger and more consistent mechanism then is that it's a matter of competition and it's an existential threat to not invest and to expand your operations abroad. Because I would suggest it's a first mover advantage for corporations, where if you're the first corporation to go into another country, you can do things like embed yourself in a market when there's little competition around. You can establish consumer trust and name recognition when you're the brand that is, most important to consumers, that they recognize the most. You can do things like buy up land that has not already been bought up. And what this means then is that from the perspective of a corporation, even if insurance is costly, if they do not go out and invest into another country, they fear another corporation is going to embed themselves there, gain massive amounts of profit, and carve out a market space for themselves, and therefore they're going to outcompete you as another corporation, which means you have a competition incentives to invest, even if there are significant costs to buying up insurance. And the reason this is important then is that this proves uniquely that we actually do still get investment into these countries, which is logically prior to opening government accessing their impact of having more pools of money for insurance companies. Because if companies do not still invest, and the pools of money that they have in insurance companies does not go up either. So I think the other reason then is that if it is the case that companies do not invest, then this also just acts as an incentive for insurance companies to lower prices. So their incentive capacity analysis doesn't really work here, because the incentive is like, otherwise you don't have any more money as an insurance company if otherwise companies, firms that would invest are turning away. But furthermore, I'd suggest that we also just increase the capacity as well, because O says that you're going to do things like, for example, there's going to be a problem where you have an oligopoly and therefore they have no incentives and they're just going to price gouge you. And the mechanism they give here is that there's going to be an incredibly high barrier of entry. But I suggest that if you have a guarantee that every single firm that's going to invest is going to need to buy from an insurance firm, this increases confidence and increases certainty, which allows more insurance companies to move in as well. And this refutes their mechanism there. But furthermore, I'd also just suggest that if the barrier is too high and this deters investments, this also symmetrizes their political their politics claim, because if it is the case that that companies are going to be deterred if the cost of investment is too high because of the cost of insurance, then these countries would also want to, for example, have less political instability to incentivize more investment into their country as well, to, for example, lower the risk rating and lower the cost of insurance companies for investing in their companies. So this is why companies are still going to invest in either sides of the house. The second thing I want to improve then is why corporations are going to be overly risky and not buy insurance, even when it's probably good for them, and even when not buying insurance is going to cause catastrophic harms. I think the first reason here is that companies are often incredibly short-termist, or CEOs know that are now in power for like shorter and shorter periods of time in the status quo, where they're insulated by things like the golden parachute, where oftentimes shareholders as well want to maximize profits in the short term, for example, to meet things like targets for quarterly earnings, which means you have short-term incentives to, for example, maximize profit and avoid paying the cost of insurance as well. But furthermore, I suggest more importantly, there's also just a massive lack of accountability for upper management as well. Where, for example, if you're investing in another company, in another country through FDI, upper management is completely insulated from, for example, the risks of things going wrong, because you can always just do things like blame the domestic country you're investing into, or for example, blame the middle managers for not telling you sooner, or for fucking up management within the country, which is why your company went under. So the TLDR here then is that when things go right, upper management can just like capture the profit and capture the prestige, but when things go wrong, they can always deflect blame, which means they have incentives to avoid insurance because there's basically no cost to taking on the potential risks of things going badly. And look, here's where this is important, because this refutes the OO claim that you're going to buy insurance strategically, and therefore unlocks all of the OG claims about why companies going under is really, really bad. But it also just unlocks OG's claim about why it's good to have a larger pool of money for insurance companies, because we uniquely prove why these companies otherwise would not buy into insurance on their side of the house, which is important for opening half. Before I go on, I'll take a POI from opening.
So these upper leaders are beholden to fiduciary obligations to maximize shareholder value and to act in smart ways. They get sued whenever they go against this. Why is this legal obligation insufficient to ensure acting smart?
I think the fiduciary obligations actually work against you. Or for example, if you are losing out on quarterly earnings now, you have incentives to not take on the cost of paying insurance to meet those obligations in the short term. In the long term, if things go under, you're not even in power anymore. Or for example, you can deflect blame and avoid legal accountability in this way. Last extension. Let's explain why companies now preemptively on the counterfactual when crises begin to happen and why this is significantly worse. And the reasons companies have the capacity to do this, and for example, to predict crises, is oftentimes like crises occur like gradually. There's often early signs of economic fragility. So for example, you see your currency going under, you see like maybe like risks or signs of a recession happening, or perhaps you have like political connections, as opening oppositions themselves say, when trying to embed yourself in government, which means, for example, you often have insider information about things going on internally. But also just think it's like reasonably obvious if a crisis from like politics is about to happen. So you have incentives, for example, to pull out, to do things like close down your locations, to transfer your workers to other locations as well, or like redirect investment and give up on existing ongoing projects and cut your losses and take the money you've already earned and leave. What is the impact of this, and why is this incredibly harmful? I think the first most direct impact of this is that it just leads to a sudden loss of unemployment if you suddenly pull out of a country that is beginning to go into crisis in the first place. This means, for example, there's less capacity for social services to keep up with a sudden influx of unemployment, especially since these are often really, really large companies that offer a really large pool of employment in the first place. This means you overload systems of welfare and, like, for example, like food banks that don't have the time to keep up because of how sudden it is. But secondly, it often exacerbates crises as well because of the sudden drop in spending that occurs in two ways. Where A, the loss of employment means that you have fewer workers who have access to disposable income, so they do fewer things like consume. But secondly, there's less direct investment itself by virtue of the company operating, so less investment into things like furniture, not furniture, like into like factories and productions and infrastructure in this way. So you have less spending in this way that stimulates the economy. What all this serves to do then is that not only does it directly exacerbate the crisis financially, but it also has a problematic signaling effect, where people that are already seeing political crises going on, they're often going to be more apprehensive. This exacerbates their uncertainty when you suddenly pull out, which, for example, if you're on the verge of a recession, people are going to save even more because you fear the recession or whatever the economic crisis is going to be is going to get significantly worse. What this means then is that the delta then is that when you have insurance, when you have insurance and you have been forced to buy insurance, if things do go wrong, you now stick it out for the long term because you know you're insured against financial harms of things going poorly within this country. But the difference on their side is that given that we've proved that companies will be overly risky and go into countries without buying insurance, that is the point at which when things do go wrong, you cut your losses and leave, and you take that money and pull out, and you exacerbate crises and hurt massive amounts of people. For all these reasons, propose.
Thank you, member of Gov. Call on member.
All right, I will take POIs in chat, please.
Again.
All right, everyone good? For anyone but the biggest corporations, PRI in the status quo is not accessible. And what happens when that's the case is not that these companies choose not to invest, but rather they invest in risky, bad ways that overwhelmingly cause shocks later down the line and hurt their profits in the long term. The extension from CG was very simple. First, the companies are going to invest even if the insurance costs are somewhat high, which buys OO at their best case, something that OG was unable to do. What Liz told you was simple. The payoff will always dominate the costs in these instances. One, because there are always incentives for insurance companies to make the cost as low as possible while still netting a profit in order to gain those furtherings. But secondly, because you reduce the risk of losses. Even if you get less of a profit, it's a much more stable form of profit on our side of the house when you're insured against the risk and losses. And that's much more viable than the counterfactual, where even if you were going to get a high payoff, you know that there's always the chance that it goes wrong very quickly and you're uninsured altogether. Op says that the first mover advantage that Liz points out doesn't really exist because it's not the 1960s and therefore these things have already been developed. But I think that's really unresponsive to the actual claim, which is when a new industry pops up, when there is an undeveloped plot of land, when there is an instance in which a country is making a strategic advantage, there are people who want to capitalize on that advantage by putting in FDI, and that FDI is necessary for these industries and things to develop in the first place. These first mover advantages constantly are generated as people continually diversify their fields of income and things like that, which means that as the market evolves, as new people trade with these countries, these instances always continually align. These incentives still exist on our side of the house. But I think the weighing that we want to do here is simple on where the money actually goes. The countries which need FDI the most are the ones who get it the least on opposition side of the house because they are risky and volatile for all the reasons everyone agrees with. What we are going to claim is simple. It's not that companies simply enter because they want the most profit. What matters is the ratio of profit to the risk they take to maintain that profit in the first place. So what companies need to move into these countries is either a really huge profit payoff, which I don't think actually happens in op side of the house. It's not like you're suddenly going to invest in Venezuela on their side because there's a huge profit because you're not paying insurance, because the huge amount of risk that comes with it naturally outscales that for the very reasons they themselves give. What we give you instead is the second thing, a good guarantee against risk. And I want to note, you only get that good guarantee on our side of the house when you empower the PRI firms in these specific areas, because FDI goes to where it matters most. When it's mandatory then, that's when you get the shore up of capital needed for the PRI firm in charge of Venezuela or whatever it's the case. I don't think it would really just be one PRI firm. I think there's tons of PRI firms that diversify because that's much better for their own individual risk. Why would you hedge your entire insurance company on one country or one area? If that area falls to contamination, it's really unclear to me, right? But in any case, when you give them this resonant capital, that's when they can actually make useful safety guarantees. That's when they have the ability to actually do more market research. That's when they have the ability to actually have the capital to back up their promises, which means you only access those safety guarantees on our side of the house when everyone buys into them. That's what Liz is explaining. And that's the point at which you actually get the money into these countries overall. So even if FDI in general places kind of decreases sometimes, we think that FDI increases in the places where it matters most on our side because we are the only ones able to give you the safety guarantee in those areas. The second extension then I think is really responsive to OO because it's basically about why companies do act riskily very often. And the responses that both op benches give are essentially people can fire your CEOs or things like that if it's the case that you're going to have a ton of problems. The response though is that it's not like CEOs just say, oh, we're just going to take the risk even when we could make a meaningful profit with PRI. The claim we're making is that PRI on their side tends to actually be far more expensive because of the lack of pool of capital, because of the lack of market research that goes into this thing, but not everyone needs to opt into it, because of the opportunity cost of simply biting the risk in the worst places on your side, because of a lack of perfect information. All of these exogenous factors are all reasons Liz gave you as to why you still make risky decisions because you don't believe PRI is actually necessary in the base case. At their best, they've proven the hugest companies can still afford PRI and are going to do so anyway. Even if that's the case, we think our impact still matriculates on the next level down when there are companies that still have a meaningful amount of FDI they could invest, but don't have the resources to actually access it. Finally, then, Liz mechanizes the counterfactual, which is, I think, where we make the main stepping point away from OG. So what this tells you is that companies are going to pull out far more rapidly, and that's uniquely the case on our side because they have a less tolerance for risk in the first place. So when you don't have access to a good PRI or aren't required to take it, and then there's political instability of some sort happening in that country, you pull out far more quickly and far more often because you don't have the safety blanket needed to weather, which means that you often worsen those crises in the long run. And I think in doing so, we mechanize over OG first, why it's the case that these companies actually act in the way that they do, but secondly, why it's so catastrophic when the harms happen that OG failed to point out. Let's respond to CO real quick, and then I'll take OO. First, I'll take the OO POI, yeah.
in ops world, when big companies see a crisis coming, they try to stop it rather than pulling out, because stopping a crisis saves 100% of your assets, whereas pulling out saves only a percentage of your assets. Stopping crises matters more than everything else for the reasons.
The problem is the capacity to stop a crisis at the point in which this thing happens. Like, if there is going to be a huge contested election, the company knows it can't do shit about that, or the company knows it can't do shit about expropriation to a certain extent. There are reasons to put pressure on companies and countries in both worlds, but when the actual risk becomes apparent, that's when you pull out and cut your losses, because that's the risk calculus. On CO, the quick thing on spillover, our impact is actually exactly this. When crises happen, you pull out often and you worsen them. And the nuances on your side, countries pull out far more quickly. But the second thing they say about how shocks affect everyone and there are huge costs, this is fully derivative of OO. So I'm going to respond to this argument as a whole. That is, when something happens in Venezuela, everyone in Venezuela struggles. First, insurance companies are certainly able to hedge against this by putting money aside or thinking about payouts over a long period of time. For the same reason that the housing industry doesn't crash when an earthquake levels 30 houses at once, because industries are ready for this and understand how to actually deal with that risk. But secondly, you don't increase the rates in neighboring countries for exactly the reason Ethan gives you, because people want to pivot and stay within Latin America, for example. So even in the magical world they claim, where there's one PRI firm handling all of Latin America, what happens when Venezuela fails is the rates on other countries probably actually lessen, because people know that they want to invest in those areas to begin with, and it makes no sense to prohibitively push them out of those areas if that's the incentive that companies are going to themselves. I don't think the case is very coherent from CO. From OO then, the central push from OO hinges upon proving that insurance becomes prohibitively more expensive, which causes FDI to decrease. I think insurance is often competitively priced for the very reason that you have to marginalize risk. So if a country is low risk, the insurance rates are very low. That's what happens with insurance generally. So I don't know why it's the case that this affects countries that aren't high risk in the first place, because the marginal difference in cost is not that high. But secondly, they say on I think the problem is that there's often a lot of lobbying and effects that are put into place to give regulations. This is the mechanization that OG lacks. When it's the case that people have to buy insurance and that push always exists, that's when companies start leaning on governments to start regulating these things far more effectively and stop price gouging from happening in the first place. That only happens when it's mandatory, because that's when you get the collective action push of every company saying we should regulate these companies, when otherwise that doesn't exist. So I think that we prove on our side that investors are actually more responsive to things like the ratio of risk to profit than to simply profit management margins itself. Finally, on the pressures to countries themselves, the argument's a bit illogical, right? Just because you are insured doesn't mean you don't hedge against the risk occurring in the first place, because it's always the best case scenario when that doesn't happen. And secondly, countries themselves often have assets tied up in these other countries that aren't related to their companies themselves. Like the US often just holds shares in other companies themselves and have intrinsic incentives to actually push against this. I think what we prove uniquely from CG then is why companies act badly on their side of the house and why we hedge against that risk in the most meaningful ways on ours. Proud to propose.
Thank the gov whip. Call on the op whip. We can turn the recording off.